Hi, this is David Daughtry at Copperwind Financial. We're doing another Dave's Talk, and what we're going to talk about today is the impact of oil prices, both from an economic standpoint around the world and also from a market standpoint around the world. What I'd like to start with is this West Texas Intermediate futures contract, the front month, and show you back, if you look from back in looks like June, July of last year when oil prices started down, we were at $107 a barrel. We got all the way down to about 43, and now we're around 50. And what the impact of that has been is you've seen a significant reduction in the number of wells being drilled. So if you look here, and this is the Baker Hughes rig count, oil rig count, and what you see is back in October we were at 1,600. So when prices started sliding in June, you actually had an increase, and that's just people that were, already had contracts. You don't set up a contract today to have a drilling rig show up tomorrow. It takes months in advance. And so oil prices started going down in June, July, but the rig count continued to increase. Excuse me. But it fell off a cliff from December on. We were down, at about 800 rigs now that are actually out there being used. One of our clients that he sells drill bits to drilling companies, he said that since December, January, their business has dropped by 50%, and he expects it may drop another 50%. Excuse me. So one of the things that you're seeing employment that is dropping significantly also in the oil patch. You're seeing that show up in excuse me, got something down the wrong pipe. You're seeing that in first-time claims for unemployment in North Dakota, Texas, Oklahoma, Louisiana, New Mexico. And what we're seeing also along there is we're seeing a decline in new projects that are being put out to bid. And so I think what you're going to see is you're going to see people here in the U.S. as consumers, they're going to get a definite benefit of lower oil prices. Where it used to cost you $50, $60 to fill up, it's $30 or $40 to fill up, sometimes even less. And I think what you're going to see is you're going to see consumer spending ultimately pick up. The estimate is that there's $700 to $900 per household in a benefit, or as far as reduction in cost for energy cost for a year, if oil stays at the $50 barrel. Now in the U.S. we spend about 1.5% of our GDP importing oil. Some other countries like India spends 5.5%. South Africa, Philippines, Taiwan, Japan, Korea, all those spend a lot more than we do as far as importing oil, because we're big producers of oil also. They're going to actually have a bigger benefit than we will of the lower oil prices. So I think globally it will be clearly a benefit, but there may be some areas where it's not going to be a benefit. If you're in Russia, if you're in the Middle East, if you're in Mexico, Venezuela, Brazil, some of those will have some problems. So what we're seeing here, and one of the things I was talking about is expenditures as far as people, consumers spending their money. FRED is the Federal Reserve Economic Database. We use that for a lot of our economic information, 15,000 different charts, so any chart that you could ever want. And what you see here is, and this is looking from January 2013, when it says real personal consumption, the real means that it's adjusted for inflation. So what you see is actually since August of last year, real consumption has declined, not increased. And where I was telling you that $700 to $900 per household, I think what you're seeing is you're seeing people not spending that money yet. Some of the economic studies that have come out in the past, when they look at this phenomenon of either somebody increasing their income or decreasing their costs, what they find is if people think it's a temporary situation, they tend not to spend that excess money that they now have. If you get a bonus and you think it's a one-time bonus and not going to occur in the future, you tend to save that. If you get an increase in your salary, you think that's permanent, you tend to spend it. So I think what you're going to see is if we go another 6 months with $50 oil and people spending $2.25 to $2.50 a gallon, I think you'll start to see a pickup in consumer spending. You are, over the last quarter, starting to see a little bit of that in some of the retailers, especially some of the restaurants, fast food restaurants, where people that we're going to spend $50 on gas and they have an extra $20 in their pocket, run down and get a hamburger or something at the local restaurant. So I think you will see some of that, but we're not seeing much of it right now. Now, one of the things that you're going to see in some of the areas, as I talked about, in the states where oil is a big thing, you're seeing a decline in some of the jobs, and they were very high-paying jobs. You had roughnecks that were making $80,000 to $100,000 a year. You had oil field welders that were making $120,000 to $140,000 a year. In fact, up in North Dakota, they were talking about $15 to $17 an hour for McDonald's workers. So they were good jobs that are going to be lost. But you're also going to see in past job losses where you've seen a big decline in oil, they've typically seen 2 to 3 times the number of jobs lost outside of the oil field in those areas. Restaurants, hotels, apartments, construction, all of those types of things go down. And so we're not seeing huge losses yet, but I think those will accelerate some. But net around the world and in the U.S., it's going to be a clear benefit by doing that, having the lower oil prices over time. And I think you can see that. I mean, when you go back to 1998, 99, here in Phoenix, we had 88 cents a gallon gas. The economy is doing quite well, and part of it was lower oil prices. Now, when we look and we say, what's that doing to the market? Well, let me pull this up. This is looking at the energy sector, XLE, which is an ETF that does energy, and it's the blue line here. And what you've seen since the first year, not a big difference between it and the GSPC. That's the S&P 500. If you look over the last year, there is a big difference. It's down 11%, and the S&P is up 14, 15, so 25% differential. But since the first of the year, not a big differential. Where we are seeing some differential, especially in the last little bit, is in some of the companies that might be potential takeovers by the big majors, like an ExxonMobil or a Chevron. This is Apache. This, I guess you'd call it a green or a teal. It's gone from being down about 6 or 7% to being up nearly 8% in just the last less than 30 days. Another one, that same type thing, Devon Energy, and as you look at it, sort of the same thing. It was down 6 or 7, up 5 or 6, dramatically outperforming the S&P during that time frame and the oil energy select ETF. So you are going to see probably some consolidation. Those that have big reserves and are doing quite well and have a lot of cash, like an Exxon or a Chevron or Total or Shell, or British Petroleum, BP, those could be people that go out, companies that go out and take over some of the smaller ones in these times. So net, I think you're going to see an increase in economic benefit all around the world with lower oil prices if they stay there. If you're in Russia, if you're in the Middle East, like I said, some of the Latin American countries, Canada and Australia are being hurt somewhat by that. But if you're in the rest of the world, things are going to be better for you if it stays at these levels. And I think that if it's better for most consumers in most countries, that's typically better for markets. Now, could prices go lower? They absolutely could. In fact, if we look at the impact of this Iranian nuclear deal, if that comes to fruition and they lift the sanctions, Iran could easily increase the supply by 1 million barrels a day. and there's about 92 million barrels produced a day right now in the world of crude. If you increase that by 1 million barrels, you could see oil down at the 35, price level pretty easily. The other thing that could also push it down, even without the Iranian issue, is the storage is nearly full. In Cushing, Oklahoma, where the storage for most futures contracts are, the estimate is that it's over 90% full on the storage. So it doesn't take much once you get to the full storage that you've got to start dumping oil on the market. The other thing is we're seeing a lot of the oil tankers, instead of being used to haul oil around the world, they're being used to store oil. And that takes another piece of the storage out of potential storage out of the works, and that could push prices lower. Long term, I think they go higher, but in the short run, over the next 6 to 12 months, they could actually go lower. So anyway, I hope this has given you some insights into what we're thinking as far as the economic and market impact of lower oil. But net, it's a positive. Thanks for listening.